Welcome back. We are at Taj Lights and, of course, for the 18th Morgan Stanley India Summit. And I have a special guest with me right now. Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley, is with me. Jonathan, of course, upgraded India on May 25th. And since then, India has been the best performing market, up about 5%. Jonathan, good morning.
Good morning.
Welcome to India.
Thank you.
Great timing. You upgraded Indian market and we have seen a 5% rally. What drives your tactical overweight stance on India now from here on?
So it's actually a call that we make in the context of a monthly model we run, and India's risen to number 3 out of 27 countries that we assess on a monthly basis. So if I was to summarize the reasons why, it's really that we see a GDP growth acceleration that's unfolding now, and we see an earnings growth acceleration. So in the most recent quarter, Indian companies had a net income beat of around 6%, whereas emerging markets overall were still missing earnings by about 2%. And in terms of that GDP growth acceleration, I mean, we've seen the numbers today, 7.9% for the most recent quarter. That means India is by far the most rapidly growing country in emerging markets.
Okay, and do you think the earnings growth will follow now for India? Because this quarter it looked like we had some green shoots. The second half of earnings season wasn't as bad as people had feared. Do you see start of an earnings upcycle, which your colleague Rhythm Desai, of course, mentioned yesterday as well?
Yes, we do. So if you look at the numbers that Rhythm and the team have in mind, we're looking at something like 9% earnings growth for Sensex this year, accelerating to mid-teens earnings growth next year. And that, in dollar terms, will translate to positive dollar EPS growth, which again is in contrast with what we see for the broad emerging markets universe.
Okay, I was just going through your last strategy note, and what stood out for me was that you see India as a low beta market. You see absolute downside for emerging markets. So in that context, are you saying that Indian market may also fall, but may fall less than the emerging market, or do you see in absolute number an outperformance for Indian market?
So, yes, we do expect emerging markets overall to decline because of that earnings fall that we're projecting. For India, I think it's reasonable to assume it can at least stay where it is in that context, if not rise. And that point about low beta is an important one. The beta is about 0.8 to the emerging index. It used to be well above 1. So India has kind of de-risked itself from the rest of emerging markets. And I think if you were to sort of summarize why, it's probably around the much improved current account balance and fiscal balance situation. So India is no longer as vulnerable to global risk-off environment when the Fed may be raising interest rates, the dollar may strengthen. And so 2013, you would have not had that same kind of low beta reaction.
So let's put it in numbers, because we know that India is trading at a premium to emerging market peers. That premium, of course, has come down from 56% to 36%, as you mentioned in your note. Do you think it can go back to 56% in current environment? Or do you think it will go back to, say, somewhere around 45, 46%? Is there any number that you've worked right now?
Yes, if you take 40%, and that's quite close to where we are now, that's the long-run average valuation premium for India going back 15 years. And we think that's warranted by the superior ROE that Indian corporates have demonstrated over the cycle. In terms of the peak valuation premium, which we saw around 70%, I doubt that we're going to go back to that. That was probably somewhat excessive in the early days of the Modi administration. But certainly it's a pretty comfortable valuation setup right now.
The other point that you also mentioned is the FII ownership, or the FII positioning, the global fund positioning for India. That's clearly come down from what it used to be. The last round of market rally was led by domestic flows, not as much foreign flows. Do you see foreign flows picking up in the second half of this year for India? And do you see disproportionate amount of foreign flows into Indian markets?
So if you look at flows in relation to emerging markets and Asian equities generally, we're actually getting outflows again right now. There was a brief period of inflows in the kind of March-April timeframe, but as China's economy slows, as we're getting weakening of commodity prices again, and as the Fed interest rate hike looms, you are getting that traditional outflow from emerging markets. But we think India will suffer less from that than the other countries in EM because of this divergent GDP growth and earnings growth environment that we just talked about.
In that context, how do you look at the domestic fund flows into India, which really has been a pillar of strength all through the month of May, when all the emerging markets fell 4 to 5%, but India actually rallied 5%?
Yeah, I think the key to the long-run development of the market remains local mutual fund and institutional flows into equities. And I think if you look at one of the catalysts for that, it will be this sustained improvement in the fiscal deficit, which unlocks the potential for lower interest rates and lower government bond yields. And again, we're pretty constructive on that. We see the RBI is able to make another 50 basis points rate reduction some point for the remainder of the year, and that will help drive this process.
50 basis point rate cut for the next calendar year or fiscal year, you said?
Out to the end of the next fiscal year.
Okay, out to the end of next fiscal year. That will be great news for the market. In fact, since we're talking about the rate cut, just a word on how global investors are viewing the current situation about the RBI governor, the fact that his term is up for renewal, but there's some bit of debate on whether that will be done or not. Would that be a material negative for Indian market if Raghuram Rajan is not re-elected as the RBI governor?
I think there are many positives behind the India story at the moment, multiple positives, but I do think the central bank governor deserves a lot of credit for the action he took early on in his term in terms of doing the hard work on monetary policy when India's macro position was more unstable. And so I think global investors view him as one of the higher performing central bank governors in emerging markets.
Okay. Jonathan, just one word. I know it will be unfair to compare from a particular point, but over the last 8 to 10 years, long-term investors have not made too much money in India in dollar terms. Do you think that will impact some of the long-term flows in Indian market?
Well, versus the rest of emerging markets, India has actually been a trend outperformer, but with a lot of volatility, which has been the result of the macro balance being somewhat more adverse in the past than it is actually today. So again, come back to that low beta point. If India is low beta to EM, but also delivering higher GDP growth and higher earnings growth, and if the starting point in valuations is reasonable, then I think you can really get quite excited about this market, and that's why we're overweight.
Okay, one confusion which prevails in the market right now is the MSCI adjustment that will take place on 14th June regarding China ADRs. If China ADRs are included, does that impact India's fate and other emerging markets' fate? In that case, does it impact the flows, or are we reading too much into that right now?
Well, this is the second phase of the ADR inclusions. They come in two phases, as you said, last year and then again next month. And then there's also the debate about the Asia index inclusion, where we may get an announcement, not that they would be included this year, that would actually happen next year. But I think you have to bear in mind that the Chinese ADRs are already very widely held by global investors as an off-index bet. So we don't think there'll be very significant fresh money buying of those ADRs just to do with the index inclusion. And indeed, on the A-share side of things, we think it's 50-50 whether they'll be announced for inclusion. But even if they are, it'll come in at a very low inclusion factor, around about 5% of the free floats. That means that the A-shares will at most account for about 1% of the EM index pro forma going forward. That's only going to have a really marginal impact on India's share in the EM equity index. And in any case, active fund managers have often deviated from the benchmark in relation to India. At the moment, they're close to like 10-year average degree of overweight on India, but we actually think that overweight will probably build going forward.
Do you get a sense that the emerging markets have put the worst behind with the February low? Do you think the MSCI Emerging Market Index or MSCI Asia ex-Japan, even though your call is that the emerging markets will fall from here, do you get a sense that the worst is behind and what we may see is a bit of a correction of the recent gains?
So our target is 755 for the EM index. That's down around 5% from where we are now on a 12-month forward basis. So no, we don't think the worst is over. We think we go back down again, not all the way to the lows we saw at the low where we were sub 700 on the index. But we think there is a headwind in relation to China's growth outlook for the second half, in relation to what we think commodity prices are going to be doing, and that's already started in May, and dollar strength, which again has reasserted itself in May. So what's interesting is that India has managed to decouple in terms of performance, as you mentioned at the start of this interview, doing very well in May, and I think that that is something that is quite striking.
Okay. Well, so that's three key takeaways. One, Indian outperformance continues vis-a-vis the EM basket. Headwinds from China in the second half, so commodity prices may not rise much. But most importantly, the MSCI rebalancing is not going to have a very big impact. And that meeting is in mid-June. That's a big relief. Should not affect the Indian weightage much. Take a break and we are back.